The world is an interesting place, and you were just telling me that you were a government major at Dartmouth, and I'm a political scientist, so I have to ask you about sort of what's going on in the world. And when I try to justify my existence as a political scientist, one thing I say to people is, look at what's above the fold in the business press, and it tends to be a political event. So in the last how many days, two of the big stories have been we have a new government in Greece that just says no to austerity. And Greece is a small country, it matters an enormous amount to Greece, but everyone's worried that this could have big impact on the euro and potentially on the global economy. Are you worried about that, or do you think that we can really, the Europeans have figured out a way to manage this stuff? It's always going to look a bit chaotic, but they'll muddle through.
So, I don't have any more insight probably than you, except my best guess is that Europe, the EU, at this point would be fine with Greece leaving the euro, and will then devote all its efforts to keeping Portugal, Italy, and Spain, in a good place. And in a sense, again, this will sound a little cynical, and it's not meant to, but I think Greece was sort of kept alive while the EU was trying to figure out what to do, and I think they would be fine if Greece left the euro. And I don't actually think.
So you're not worried about contagion and all these other sexy topics?
I'm not worried about contagion at all. If Greece leaves the euro tomorrow, I believe the central bank will move very aggressively to assure the rest of the world that Spain, Italy, and Portugal, and any other European economy or any other member of the EU is going to remain.
There's a quotable quote for anyone in the audience who's interested in a scoop.
Hey, look, I could be wrong, but
hey,
but if you sort of look at what's gone on the last couple of years, that it sort of lines up that way.
Okay, so second geopolitical thing. So today was a bad day on the markets. Those happen. A lot of the stories were about domestic earnings and things like that, but there was also a Lebanese attack into Israel. Is instability, chronic instability in the Middle East a big story in the markets?
Yeah, so I think geopolitical instability in general is going to be a very big story in the markets going forward. We've reached a point where U.S. equity markets are pretty fully valued, and by anybody's measure. And what you tend to see historically, anytime you get to these kind of valuations, it doesn't take much to make people nervous. And so that can be geopolitical uncertainty, that can be a bad set of earnings from two or three companies, significant companies. Who would have thought the price of oil dropping significantly would jar the markets the way it did, a few weeks ago? For the U.S., if you think about our economy, which is 70% consumer driven, we're now $50 into the decline in the price of oil. That's like $125 billion tax refund to the consumer, $150 billion depending how you calculate it. I don't know, that's generally good news for most companies in America who serve consumers, but of course what you've seen is all the oil services companies are being hurt. Caterpillar today, had the earnings, earnings disappointment, and Caterpillar talked about the impact of lower price oil. I would have thought lower priced oil 6 months ago would be a really good news story.
So Caterpillar is an interesting company. They've done an enormous amount of heavy lifting, no pun intended, in China in infrastructure. So last week China came out with 7.4% as the growth rate. China's transitioning from investment and export-led growth into consumption-led growth. Is slower growth in China a good thing or a bad thing?
Well, I think it's an inevitable thing. If you looked at 7 to 8% growth and just extrapolate out, it's not sustainable. So I think you're gonna see the Chinese slowly but surely back that down. And I do think you're right. You're going to see a shift to the consumer. One of the interesting things in discussions we have in China, the regulators and the policymakers really understand the fragility of their capital allocation mechanisms. In the U.S., for example, roughly 50% of capital is allocated through the capital markets, people like us, investment managers and so forth, and 50% is allocated through the banking system. in China, it's 98+% is allocated through the banks / the government, and they are desperate to move toward a more capital market orientation.
So retail finance will be a big story. When you think about China, is it a place where Vanguard would invest money coming from offshore, or do you think the upside for you is becoming an investment manager for Chinese people who are going to be increasingly concerned about their retirements?
Right. So the first part of the question, as you probably know, investing directly in China in the public markets, you've got all kinds of hoops you got to jump through, and you typically get a pretty small allocation, if you will. The Chinese are still very worried about volatility of capital flows from the outside. So for us to manage at the scale we manage, we're going to need to get a much bigger allocation than has been typical. So we're having those kinds of discussions. We actually do work with big Chinese institutions today. I would say our hope is that someday we will be able to work with Chinese retail investors. I'll give you an interesting statistic. I think there are 80 million individual Chinese investors with $50,000 or more to invest, which is a staggering number. It's a small percentage of their population, obviously.
And so that's currently sitting in banks earning sort of zero interest?
It's in banks or in the limited number of local funds that are available in the Chinese market. So if you're somebody who does what we do, you look at that and you say, if you can figure out a path there, it's a pretty attractive marketplace.